Let me guess. Right now, you feel as though you are paying more tax than you should be paying. In fact, you probably know that you are paying more tax than you should be paying. You look at your friends or your family members, and they're pretty much earning the same income as you. But why is it that their tax is less? Or when it comes to your tax returns, why is it that they're able to get refunds, but you are now having to pay money in? Or even in instances where you're getting a refund on your tax, why is it that others are getting a lot more than what you get? I'm DHEVAN from Retirement Wellness Essay, and what I want to share with you today are 3 ways in which I can guarantee that your taxes can be reduced. The only thing I need from you is to watch the video to the end naturally, and to obviously make sure that you implement these techniques. These are techniques that I've been using for my clients over the last 15, 20 years. I've also been using them for myself, and they work. They work. So you just need to have an understanding of them and then start putting them into practice. Now let's guide you through them one step at a time. The first technique I want to share with you is setting up something that you might already know, and that is a retirement annuity or an RA. Now hold up. I know what you're thinking. This is something that you already know. You already know about paying towards a retirement annuity. You already know that you get the tax refunds. Yes, that's one benefit, but I'm going to show you 2 benefits that I pretty much know that you're not aware of in terms of tax saving for a retirement annuity. Now, just a quick recap for those of you who are not familiar with a retirement annuity. I just want you to understand how taxes work, and then we can then start to see how we're going to have this work in our favor. Now, as a rule of thumb, what you need to know is we are taxed based on our income. So we are taxed on income, and that is done on a sliding scale. So if we have to look at a tax table, I'll get one up for us now, but inside the tax table, you're going to see that SARS operates on the sliding scale. And the sliding scale simply means the more income you earn, the more tax you're going to pay. Let's have a look at that as this. So up here now, we can see this is the tax guide from SARS. You can see it's the 2022 tax guide. And from this, what I want to share with you is these are the tax rates. And what you notice here is the more income you earn, the higher tax you're going to pay. So it starts off at 18%, but it actually starts off at 0, because there's ways in which you pay no tax. And then as your income starts to increase, you will start to pay more tax. So you'll see 18, 26, 31, 36, all the way up to 45%. Now, naturally, the easiest way for you to reduce your tax is just to reduce your income. But who wants to earn no income in order to pay no tax? Naturally, none of us. So I'm guessing you want to make a lot of money, but you want to find a way in which you can pay the least tax possible, legally that is. So let's go through it. One of the ways in which you can save on tax is through the bottom here of the tax guide, which is called deductions. So you'll see it here, deductions. And it says clearly retirement fund contributions. Retirement fund contributions. I won't get into too much of the fine print here, but I want you to pay attention to this figure, which is 27.5%. Now let's head back onto the iPad, and I'm going to guide you how this figure works. Now you're welcome to watch this video maybe twice or so that you can understand it, but I'm going to use a very, very basic example here, and then you are then going to relate this to your set of circumstances. Let's assume that your income, so this is your income, just for the purpose of making the math look easy here, we'll assume your income is 100,000 Rand for the year. So that's your income for the year. You remember the 27.5% I just showed you now on the tax guide? That is the amount that you can contribute towards a retirement fund saving. It's an amount that you can contribute to retirement fund saving. So what this means in our example, you have 100,000 per year, that's your earning. You could contribute 27.5% of that, meaning you could contribute 27,500 Rand. And if you do, that amount will be deducted from your income. So I'm going to go through this again a little bit more slowly. We're saying that your income is 100,000. And remember, we looked at this tax scale and we said the higher your income, the more tax you're going to pay. So on 100,000, you're paying X as a tax rate. Then I'm saying that if you contribute towards a retirement annuity or a retirement fund, you could contribute 27.5% of that total earnings. In our example, that is 27,500 Rand. So 27.5% of 100,000 is 27,500. What it means is, for tax purposes, your income with SARS is no longer 100,000. It's 100,000 less 27.5%. So doing that math quickly for us, it means your new income is it's around 70,000. So yeah, I'm not going to get the math to be 100% correct this time, but let's see, it should be around 72,500. So what it means is you've now dropped your taxable income. So initially, SARS is saying to you, listen, your income is at 100,000, so you're going to pay tax on 100,000. It's X percentage. But then when you show them that you're contributing towards a retirement annuity or towards a retirement fund, remember this is the first technique I'm showing you, and we've got 2 more to go. Then you now are putting yourself in a position where your taxable income is reducing to 72,000. And remember the sliding scale I showed you with SARS. So because your income is reducing, it means the tax that you pay is now reducing. If you have a look at this, you're still contributing, you're still earning the same income, 100,000, but in the eyes of SARS, they're seeing that income to be 72,500, which then creates the saving for you. Now, perhaps you're not in a position where you can contribute 27.5%, but I'm sharing this video with you because it doesn't matter what percentage is, what that percentage is. As long as you contribute something towards a retirement annuity, it's going to benefit you in some way. Now, if you already knew that, I promised you 2 more things that you don't know about a retirement annuity. And the first thing that I want to do or let you know is the growth inside the RA is taxed at 0%. What that means is you have a retirement annuity, assume your value is 500,000 or 1,000,000 Rand, and it grows by 100,000. So whatever you had grew by 100,000. That interest, that growth that you've had for that tax year, the tax rate on it is 0, meaning you're not paying tax. So in essence, you are growing your wealth brilliantly, but you're not having to pay tax on that growth. You see, it's very different to, for example, if you had money in a bank account or a unit trust investment or even an endowment where those vehicles are taxable, that growth becomes taxable. The second thing I want to share with you is just by contributing towards a retirement annuity, you are now creating a saving on what we call estate duty. Estate duty is a tax that you'd pay at the time that you pass away. So it's a tax that you pay on whatever assets you own, which is your home, your car, it's your, your household contents, certain policies that you have. So all your investments, money you have in your bank, all of that forms part of what we call your estate. And your estate is subject to what we call estate duty. It's a tax that government has when you pass away. Now, when we contribute money to a retirement annuity, that money, whatever sits inside there, let's assume it's 1,000,000 Rand, that will not attract estate duty. There is a certain loophole around this that government has created for wealthy individuals that want to sort of exploit the RA. But for most of us, that estate duty saving there becomes phenomenal. So that means you're getting 3 huge benefits from the retirement annuity, which is not available in most other sources. And this is the first way that you can instantly save on tax, and it's contributing towards a retirement annuity. The second way I want to show you, also another brilliant way to save on tax, is your pension fund or your provident fund. Now, I know you might be thinking, hey, you're already contributing to a pension fund or provident fund. Now, if you are already contributing there, remember earlier I took you through the tax guide. And what we saw on the tax guide, let's bring that up quickly. What I'm going to show you on the tax guide is that your taxes are not just restricted to the government or to your retirement annuity. So if you have a look at the tax guide, here's your deductions, and they are referring to this as retirement fund contributions. Retirement fund contributions. What it means, it doesn't matter what the retirement fund is. You see, it could be a retirement annuity, it could be a pension fund or a provident fund. These are retirement fund vehicles. So government a few years ago consolidated all of this. Your 27.5% is made up of all of these benefits, meaning you could contribute 10% to your retirement annuity and 17.5% to your pension fund or provident fund. That makes up your 27.5%. See? And then you're enjoying all the same benefits I've just shared with you here. See, in terms of the growth. So let's go have a look back in at the iPad. So I'll illustrate that to you again. So if you take a look here, these tax benefits will still apply in terms of your pension fund and your provident fund. So you're gaining on that. We're still using the same 27.5%. So if you really think about it, if you don't have a retirement annuity, there's no need for you to start one up. You could just as easily increase the contributions to your pension fund or provident fund. Now, if you're not already aware of this, you can have a chat with your HR. You can do this incrementally. And then the benefit, remember, is your company might be paying a portion and you are paying a portion towards your pension fund or provident fund. You're just saying that you're increasing your contribution here. See? And just by doing that, you then would take advantage of the tax saving. So government now becomes aware that you're contributing extra, and that also creates the tax saving. And the third thing I want to share with you then is in terms of the bank. Now, a lot of you, perhaps you've got some money that's inside of a bank investment. So you've got money that's saved there and you are earning interest. It could be a bank or it could also be a unit trust, by the way. Yeah. So a bank or unit trust investment, but either way, you are earning interest. So you're making interest. Now, what happens is that interest, the amount of interest that you make, let's use an example, and we'll say that interest is 100,000. Now, in this example, that 100,000 is going to be added to this 100,000 income that you have here, which means your total earnings is 200,000. And if you remember the tax scale I showed you earlier, the more income you make, the more tax you're going to pay. So when it gets added, that 100,000 plus this 100,000, that's going to push you up a tax rate, and it's going to mean that you're going to end up paying tax. Now, your way to counter this, government has, a while ago, they introduced what they call an interest exemption. So I'll put that in here. They have what's called an interest exemption. It's 23,800 if you are below 65. I'll put you below 65. And it's 34,500 if you are 65 and older. So you want to be mindful of this, because if your interest exceeds these amounts, then it means the surplus is not going to be added onto your salary, which then means you're going to end up paying more in tax. Your way to counter this, if you are in this position, is you want to make use of two things. You could make use of what's called a tax-free savings. So you could create a tax-free savings. There's a limit to how much you could contribute to that. But just by taking some money out of the interest and investing inside a tax-free savings vehicle, this vehicle itself is free from tax, as the name would indicate, which means you're creating a saving. You're reducing your capital inside your bank or unit trust, which means you'll earn less interest on the money that's there, which means this would naturally reduce, you see, and could put you back in line here. Now, there's a limit to how much you could contribute here, so you want to be mindful of that. The trick, again, or something else to be mindful of here, and it could work either way, you could have a spouse. So if you are married in common to your property, then the interest gets shared. So this income would be split into, it means 50,000 to you, 50,000 to your spouse. But the opposite is also true. So if your spouse is earning interest, half of that interest also adds up onto your interest. So again, something else that you want to be mindful. One last thing, a technique that can help you to resolve this is you could also take a portion of this and invest it inside your retirement annuity. So you could do a lump sum investment there. And by you doing that, you're now able to get the benefits that we mentioned here, as well as here. Now, I hope this video has found, you found this video extremely informative and helpful. More importantly, I want to hear from you on how this is helping you to save money. So post a comment below and let me know. Remember to subscribe to our videos on YouTube, and also if you're happy with the video, like it, and remember to share with others as well. Thank you so much.